So today I really want to explore why housing is so cooked for the younger generations within Australia, mainly millennials and zoomers. Entertainment only, not financial advice. So I wanted to start by really outlaying the situation for millennials and zoomers. And this is a situation that I myself and a lot of my friends are in currently. So as the younger generation, you're generally priced out of purchasing detached dwellings within the middle rings of cities. I'm talking a detached dwelling, 5 kilometers to 20 k's from the CBD. I myself live in Melbourne, and to purchase a detached dwelling within these areas, you're probably looking at, entry price of $1.25 million. So if you're a young person and you want to purchase housing, you're generally left with sort of two main options as an owner-occupier. You can purchase an apartment within the city or the middle ring, or you can purchase a detached dwelling on the outskirts of town in that outer ring and give up some of the lifestyle and potentially have a large commute to work. What I would say and what I've seen is that people generally outgrow an apartment. They might purchase one in their late 20s and then in their mid 30s when they're looking to start a family, etc. The apartment's too small and they have to upsize. And generally, apartments aren't a great investment in Australia. They're a bit of a mixed bag. And this is very dependent on the location, the typology, and the land component of the apartment that's purchased. If you purchase a modern apartment with a lot of apartments in the block, generally they just stay flat in value or maybe decline. So you hold that asset for 5 years and potentially you sell it for the same price that you purchased it for. I think purchasing an apartment can be okay. You just need to really target scarcity and go for that older style stock with large floor plates in buildings with not a huge amount of apartments. So to basically visualize these options, you've got the older style apartment with, maybe 10 in a block. You've got the modern high rise with hundreds in a block. And then you've got the dwelling on the outer ring of Melbourne, maybe it's a bit run down, and you've got, an hour's commute into the city. Towards the end of the video, I'm going to outlay some housing strategies like rent vesting, where you can rent the, inner city apartment and purchase the dwelling on the outskirts of town, where you can invest in the better asset but keep the inner city lifestyle. So I think everyone in Australia basically knows that house prices are really outpacing incomes. This chart gets thrown around a lot. It's basically the median house price versus the median income over time. So you can see all the major cities of Australia in the 1980s, most of them were about 3x income, and they're all about 6 to 15x income in the early 2020s. Additionally, I'd just say that there's a bit of a lack of understanding from older generations around the affordability constraints in Australia. I'm based in Melbourne and I speak to a lot of older people and they just can't understand why I haven't purchased a house in Hawthorne. And you explain to them that a family home is like $2-3 million. They just don't understand how unaffordable that is for current incomes. And I think within Australia, there's a big cultural mindset around being an owner-occupier, and that's really ingrained from previous generations. It was the Australian dream, and that was achievable when house prices weren't at such extreme income multiples. I think being an owner-occupier makes a lot of sense when house prices aren't at such crazy income multiples. But unless you're doing really well, stretching yourself and trying to purchase a detached dwelling is just going to put you in a lot of debt. You're going to be a slave to the mortgage payments, and it's not tax-effective debt on your primary place of residence. And you're really heavily incentivized to throw everything that you have at that mortgage. And you miss out on the opportunity cost of being able to invest that capital because you're so heavily incentivized to pay down that mortgage. I thought I'd just have a quick look at some of the numbers around purchasing a primary place of residence. These numbers are probably quite indicative of Melbourne. So as I said, probably an entry priced dwelling in that sort of middle to inner ring where people want to live. You're probably looking at $1.25 million. You've got about 70 grand in stamp duty and call it 6 grand in legals. If you're going in with 20% equity, that's $250,000 of equity required. So your initial outlay is around $325,000. So you're dropping $325,000 about $75,000 just gets eaten up in transaction fees. And then you've got $1 million in debt. Run that at the current mortgage rate of 5.75% thereabouts for an owner-occupier loan. You're looking at an annual mortgage payment of around $71,000 on a P&I loan, and that's about $1,400 per week. So for a working age couple to service $1 million of debt, like, you have to be doing pretty well. This all has to be paid with after-tax income, and then if you add kids into the mix, it just gets harder and harder. Just as an exercise, think about what you could financially accomplish putting $325,000 into the stock market just in an S&P 500 index, and then adding $71,000 to that position per year, and just renting the same house for probably half the cost. But I just think culturally in Australia, that owner-occupier mindset is just so strong. You know, you're paying 5.75% on $1 million worth of debt when you could rent the same house on like a 2.5% yield in Melbourne. So now I want to touch on why I think houses are so expensive. So I think housing is quite a multifaceted and complex issue. And I think that the key reasons are money supply growth and inflation, erosion of wages, increased demand for housing, so we've got a larger population and a lower household size, the dwelling supply lagging the population growth, and in addition to that, we've seen construction price inflation over the last 5 years. We've got poor distribution of housing. It's quite anecdotal, but you know, you walk through Toorak or any of the blue chip suburbs, and generally you see a lot of old people living in large houses with empty bedrooms, where it would probably be more efficient moving out of that house and letting a family move in. And additionally, I don't think the situation is helped by keeping housing as an investment asset. And I say this as a property investor. I also think as Australia currently stands, investment is likely needed to provide that rental stock because governments have been relatively absent from the housing situation up until a few years ago. And if we were to remove housing as an investment asset, the government would really have to step in and provide a lot of rental housing stock in that absence. So looking at money supply growth and general inflation now, this topic's a little bit hard to wrap your head around. But basically, when we look at the M3 money supply for Australia, this is a metric of money supply that economists like to look at. Since the early 90s to the early 2020s, the money supply has grown around 1,400%. And this is really the concept that $1 in the early 90s is not equal to $1 in, 2025. In the early 90s, a can of Coke was probably 50 cents. And a can of Coke today is probably, $3.50. And a can of Coke in 10 years' time will probably be $7. Who knows? Money sort of devalues over time and loses its purchasing power. Over the same time period, you can see that the median house price in the early 90s within Australia was around $200,000. And today it's, around $930,000. So over that same time period, we've seen a growth in the median house price of around 460%. So the growth in the median house price is actually less than the growth in the money supply. Looking at wages now as well in relation to the growth in the money supply, we can see that since 1990, the median full-time wage has grown about 320%. So if you compare that 320% to the growth in house prices, median house has grown about 460%, and that has outstripped the growth in wages. What's interesting is we look at the price of gold. Since the early 90s to 2025, it's grown about 1,060%, while the money supply has grown about 1,400%. So when you think about gold, it's effectively an asset that is somewhat limited in supply. There's a bit of gold discovered each year, but the supply of gold isn't dramatically growing. So since it's an asset with a fixed supply, it's quite good to look at and price other assets in terms of gold. So if we look at house prices priced in gold within Australia over that same period, I got ChatGPT to whip up this graph and it used these sources down here. So we can see in 1990, it took about 200 ounces of gold to purchase the median house. And then probably the peak was in 2010, where it took around 375 ounces of gold to buy the median house. And when you price the median house in terms of gold in 2025, the median house is less expensive than it was in sort of 2010 and 2015. So that's all good and well. But when you look at the median annual wage priced in gold, you can see that it's fallen off a cliff over the same time period. So in 1990, the median annual wage could buy 60 ounces of gold. And in 2025, that's looking to be 30 ounces of gold. So this chart was also produced by ChatGPT from the following sources. So the conclusion that we're coming to from these two charts is effectively that housing isn't really that much more expensive than the early 90s. It's just that real wages have basically fallen off a cliff when compared to the gold price. So one of my favorite quotes of all time from a YouTuber called Analyzing Finance with Nick: houses haven't gotten more expensive, you've just gotten poorer. So pretty uplifting stuff. So I want to touch on wages now, and I'm by no means an economist. So I really wanted to understand why wages have actually eroded over the last 35 years. And in my mind, if all things were equal, we'd probably expect that wages should move in line with the money supply and inflation. But at the same time, there's some key reasons as to why wages may have eroded over time. So you look at wages and they're basically set by the supply and demand for labor. And different industries at different times have different supplies and demands of labor. Just as a brief example, over the last 10 years, the tech sector was really flying. I'm not an expert, but a good software engineer was getting paid really good money. But over the last few years, with interest rate increases and the economy getting a bit more dicey and the integration of AI, it seems like there's been a lot of layoffs in the tech sector, and the wages that were achievable a few years ago aren't there anymore. So the supply of labor is still there, but the demand has dramatically dropped as tech companies look to slash costs and integrate with AI. So there's also globalization and outsourcing in the mix. Big example was manufacturing and globalization. The manufacturing jobs that were present in the 50s, 60s, and 70s, a lot of the manufacturing jobs were outsourced to Asia as wages were lower in Asia. And that basically meant that manufacturing jobs in, America, Australia really dried up from a demand perspective. So wages decreased. Similar concept with automation. Another potential reason that wages may have been eroded would be just weaker bargaining power. Generally, there's been less unionization of workers over the last 35 years. And there's also the concept of large firm domination. So potentially, instead of having multiple smaller employers, we've seen large firms dominate the market and have more power to basically set wages. And finally, a bit of a contentious one, but migration could erode wages. Migration could also stimulate demand for services. But if you just think about an industry like construction, where we currently have a big undersupply of trades, if we were to grab 500,000 skilled tradespeople from other countries and add them to our construction labor pool, it's just obvious that the supply of labor would increase and the wages would drop as a result. I just got back from a family holiday to Singapore, and speaking to the locals there, I asked them about the wages in construction. And a lot of the construction within Singapore is undertaken by migrants from the surrounding countries. And the cost of labor in construction in Singapore is very moderate compared to Australia. And you can see it in their city. They've got towers with bridges across. The scale of their city is ridiculous compared to Australia. And in Australia, we just can't build structures like that because our construction costs are quite high by comparison. An additional reason could be that wages are just sticky by nature. Companies only really increase wages once a year. And if you have a year where inflation is really high, wages may not escalate according to inflation. So during COVID, maybe you had a year where inflation was 7%, and you get that wage increase from your employer and it's 3%. So touching on population growth now, I'm just recycling a lot of these slides, but population growth within Australia has historically been between 300 and 400,000 people per year. Dropped off during COVID, and then post-COVID, we grew our population in 2023 by around 650,000 people, which represented a 2.5% increase, which is quite high. Australia has doubled its population from the early 80s to the early 2020s, going from around 14 million people to around 28 million people. Over the same time period, the average household size has decreased. So we had 2.9 people per household in the early 80s, and that's now just under 2.5 people per household. You can also see the density of our cities compared to some of the cities around the world. We've got quite dense central business districts, but low density in the outer suburbs compared to other cities of the world that are quite dense by comparison. And because our population growth has been relatively high, Housing Australia put out this paper in 2023 that predicted a shortfall in the supply of housing within Australia between 2024 to around 2029. So there's more household formation than the supply of dwellings, creating a shortfall. So basically, we can't build enough housing at the moment to keep up with the new household formation. And then this is really seen in the vacancy rates of each city. So vacancy rates are basically the proportion of vacant rental stock at any given time. You can see in Melbourne, we're at record lows. We had a bump up during COVID. And when vacancy rates are low and tight, it basically means that rents are typically going to run up in price. Sydney as well, we're sitting at record tight vacancy rates, around 1%. Brisbane, we're at the tightest vacancy rates since 2005, so around 1%. Perth, we can see we had really high vacancy rates in the 2010s, but we're at record lows, sub 1%. Adelaide, we're at sub 1% vacancy rates. And Hobart were also at sub 1% vacancy rates. So this really just shows that the supply of housing isn't keeping up with the population growth within Australia. Looking at construction now. So looking at dwelling completions, we can see that over the last few years, the biggest year was 2018, where we produced 220,000 dwellings. And in 2024, we only produced 180,000 dwellings. And the primary reason for this is that residential construction costs have really run up since COVID. So from early 2020 to June 2024, we saw around a 34% increase in the residential construction costs. We're in mid-2025 now, so it's probably closer to 40%. And what this has basically meant is that in Australia, most of our housing supply is supplied by the private sector, so, private developers. And with these construction cost increases, they are less profitable undertaking developments. So as costs have increased, along with finance costs as well, developers are producing less dwellings. So I currently work within the development sector. And basically what we're finding is that since the COVID era, to be able to make a profit on a development, you have to sell it for considerably more than pre-COVID values. And the market isn't willing to purchase the developed product at these levels. So for developers to be profitable and pump out more housing, either values need to rise or construction costs and financing costs need to come down. And construction costs aren't very likely to come down significantly. So effectively, house prices need to rise for developers to be able to pump out more housing. Or the public sector needs to step in and provide more public housing, which is what they're currently trying to do. But also a lot of the state governments aren't in great financial positions, especially Victoria. So they're a bit financially constrained to deliver significantly more housing. Or additionally, we could slow our population growth for a few years and give the country a bit of time to breathe and deliver more housing. Another factor worth discussing is the distribution of housing. So it's estimated that baby boomers, aged 60 plus, own more than about 4.5 trillion in wealth. and much of this is held in property, according to McCrindle 2024. And the market cap of Australian residential real estate is around 11.1 trillion at present. So if we say that the cohort of 60 plus probably owns about $3 trillion in property, they probably own over a third of the residential real estate market, and approximately 23% of the Australian population is over 60 in 2024. So just speaking anecdotally, when you walk through some of the established inner city suburbs within Melbourne, you'll see a lot of the older generation inhabiting the homes there. And often you've got an elderly couple in a 4-bedroom house. This is entirely anecdotal, but it's kind of what I'm seeing on the ground. And from the 2021 census data, it looked like 76.8% of households had a spare bedroom. So, around 30% of houses had 1 spare bedroom, 30% had 2 spare bedrooms, and about, 12.5% had 3 or more spare bedrooms. Maybe 1 spare bedroom is somewhat logical because, you'll have a home office. Additionally, during the 2021 census, about 10% of private dwellings were unoccupied. I'd take this figure with a grain of salt because there were various reasons for the properties being unoccupied, such as renovation, being sold as vacant possession, awaiting new tenants, and then there were also people living away, homes deemed unlivable, and holiday homes. So I've seen this figure thrown around, and if you're including holiday homes into this figure of 10%, a lot of these houses aren't going to be in locations where people actually want to live. There are actually more houses than you'd think that are in decent condition and have been vacant for multiple years. I live in the Bayside suburbs of Melbourne, and if you're actively looking for it and you go for a walk through the suburb, there are quite a lot of houses that have been left intentionally vacant. I'm sure it'd be a low percentage, and I'm sure this issue is blown out a lot on social media, because if you owned a property, especially with a mortgage on it, why wouldn't you rent it out and get the cash flow, get the 3% gross return per year? Not to mention that there's some pretty significant taxes, especially in Victoria, for leaving an investment property vacant. And I'd probably agree that people should be heavily disincentivized to leave properties vacant. So touching on housing as an investment asset now. So when you look at the yields of housing within Australia, they're quite low compared to the rest of the world. And maybe this graph is a bit simplified. Maybe our cities are less dense than some of these cities with higher yields like New York and Chicago and Dallas. But effectively, housing in Australia is priced like a growth stock. Investors are effectively willing to accept lower returns from rents because they're expecting good capital growth within Australia. And you can understand why the market is pricing this. We've got high population growth. We're a very politically sound country, and our cities are a lot less dense than some of the other cities in the world. What I would say is that negative gearing and capital gains discounts definitely keep the yields lower within Australian cities. Because again, it basically means that investors are able to accept lower yields and rental return in favor of greater capital growth. So negative gearing, as an example, investors are willing to accept lower yields because they're going to get some money back at tax time each year if they're suffering a loss on that asset. And additionally, you're going to keep more of the capital growth due to the capital gains discount. So you're probably willing to accept lower yields in favor of that capital growth. What I would say is that negative gearing is an accounting principle. So the theory of negative gearing is that you're not taxing the revenue of the investment, you're ultimately taxing the profit. And companies do this. If they take a loss one year, they carry it forward and it gets built into the accounting of the next year. If you were to remove negative gearing, I think that rents would increase quite dramatically. And this is because we have very tight vacancy rates at the moment. So if you were to remove negative gearing and vacancy rates were very high, rents can't increase. But if you remove negative gearing while the rental market is incredibly hot, landlords are going to pass those additional costs onto the renters because they can. The market is tight. So I think we'd see a spike up in rents. And that's basically because investors want higher rental yields if negative gearing is to be removed. and the market will absorb rental increases due to the tightness. So what I would say around housing as an investment asset, if the government were to, remove negative gearing and the capital gains discount, they really need to step in and provide greater public housing if they want to do this. Because given our population growth and our inability of the private sector to deliver housing, if the government scraps negative gearing and the capital gains discount, rents are just going to go to the moon. So finally, I wanted to touch on some implementable housing strategies for millennials and Zoomers. So going back and using that example of purchasing a house for $1.25 million, you've got a huge initial outlay of $325,000. And you're paying about $71,000 a year in mortgage payments on a P&I loan. So assuming interest rates stay relatively stable and you don't refinance on that mortgage, the mortgage payments should stay relatively consistent over the course of that mortgage. So you're paying $70,700 in year one, and you're paying that exact same amount in year 30. So we've already covered the principle of inflation and why money becomes less valuable over time. So this basically means that paying your mortgage is going to be the hardest that it ever will be in year one. And then, in year 30, $70,700 will be a lot less money in year $30. So in 2055, $70,700 won't really be that much money by comparison. What I would say, without going into too much detail, is that banks understand this concept, and when they're structuring a mortgage, you can see that they front load all the interest. So for the first 18 years of the loan, you're paying more interest than you are principal. So on that $1 million of debt, provided that the rate stays stable and you don't refinance, you're paying total interest on that loan of around $1.12 million. So a strategy that you could implement is the 6-year rule in Australia. So if you purchase a house as a primary place of residence and you live in it briefly, you can rent it out for up to 6 years and then move back into it as a primary place of residence and be exempt from any capital gains tax. So if you decided that you do want to sort of stretch yourself and purchase a house in the inner city, you could inhabit it briefly and rent it out for a few years while those mortgage payments are at their most burdensome. You could then just rent cheaply elsewhere, grow your equity in the house, increase your income, and that debt will sort of be inflated away while you rent it out slightly. And then you can move back into that property in, 5-6 years time when maybe the mortgage payments are a bit more manageable. I'm not an accountant, so run this scenario with your accountant and your mortgage broker. But also, while you're renting the house out, the debt on it is more tax effective because you can negatively gear that loan. And then an increasingly popular strategy is rent vesting. I personally do it, where you don't want to purchase the apartment in the city because you don't want financial exposure to an apartment because they're a bit of a mixed bag from an investment perspective. So you purchase properties on the outskirts of the city with higher yields at more affordable price points, or you purchase regionally. Additionally, you could just rent the apartment in the city and grow a stock or crypto portfolio, whatever you want to do. Because by purchasing a primary place of residence, you're really tying up all your capital in that property. So you could potentially get superior capital growth, tax-effective debt, and you can avoid the investment exposure to purchasing an apartment and just rent it for the lifestyle. So I think inherent in this strategy is really changing your mindset around being an owner-occupier and just being comfortable with the fact that it might not make financial sense for you to purchase an apartment or purchase a dwelling close to the city and be underwater in debt. And from a lifestyle perspective, it might not make sense to live on the outer fringes of a city or live regionally. So we'll just wrap this video up. These are kind of my thoughts on the housing situation for millennials and Zoomers. Tell me if you agree or disagree. Check out my channel. I've got a lot of videos on investment property content, and join the Discord if you want as well. Thanks.